In 2020, a 20-year-old college student named Alex opened a Robinhood account with $4,000. He discovered something called a margin account. Within 6 months, he had turned that $4,000 into over $40,000. He was up 900%. Then in 4 days, he lost all of it and then some. He owed his broker $730,000. He was 20 years old. This isn't a rare story. This is what leverage does when you don't understand it. By the end of this video, you will understand exactly how margin and leverage work, why they destroy most people who use them, and the specific rules that the 10% of profitable traders actually follow. Let's start at the very beginning. When you open a regular brokerage account, what's called a cash account, you can only invest money you actually have. Simple $1,000 in and $1,000 to invest. But a margin account is different. A margin account lets you borrow money from your broker, using the stocks you already own as collateral. Think of it like a mortgage. When you buy a house, you don't pay the full price up front. You put down 20%, maybe 10%, and the bank lends you the rest. You take ownership of a $500,000 asset with just $100,000 of your own money. Margin works the same way, except instead of a house, you're buying stocks. You own positions worth far more than the cash you actually deposited. Now, the amount the broker requires you to deposit upfront is called the initial margin. In the US, FINRA requires a minimum of 50%. That means for every dollar you borrow, you must put in at least $1 of your own. And there's a second threshold, the maintenance margin. Once your account falls below 25% of the total position value, you get what's called a margin call. We'll get to that in a moment. That's where the horror story begins. Now, margin is the mechanism. Leverage is the multiplier. When you use a margin account to control more capital than you actually have, you're using leverage. A 2-to-1 leverage ratio means $1,000 of your money controls $2,000 worth of stock. 5-to-1 means your $1,000 controls $5,000. 10-to-1 means $10,000. Now here's where it gets dangerous and beautiful, depending on what side of the trade you're on. Let's say you have $1,000 and you invest it with no leverage. The stock goes up 10%. You make $100, your portfolio is $1,100. Fine. Now let's say you use 5-to-1 leverage. Your $1,000 controls $5,000 worth of stock. Same stock, same 10% move upward. Now let's say you use 5-to-1 leverage. You don't make $100, you make $500. That's a 50% return on your actual money. Not 10, 50 from the same trade. But now, same trade, same leverage, except the stock goes down 10%. You don't lose $100, you lose $500. You just lost 50% of your capital on a 10% market move. And if the stock drops just 20%, your entire position is wiped out. Your $1,000 is gone, zero. Now let's talk about the thing that ends more trading careers than anything else, the margin call. Here's exactly how it works. Walk through this with me. You deposit $5,000 into a margin account. Your broker lets you borrow another $5,000. Now you have $10,000 to invest. You buy $10,000 worth of a stock. Now let's call it StockX. Day 1. StockX drops 20%. Your $10,000 position is now worth $8,000. Your equity, the portion that actually yours, drops from $5,000 to just $3,000. That's still fine. You're above maintenance margin. Day 2. StockX drops another 15%. Now the position is worth $6,800. You owe $5,000. Your equity $1,800. That's only 26.5% of the position. You're right on the edge. Day 3, stock drops just a little more, boom. Your equity falls below 25%. The margin call arrives. Your broker gives you two options: deposit more cash, or they will liquidate your positions immediately at market price. And here's the brutal truth: they don't wait. They don't call you first. They don't ask you if you have more money coming. And they liquidate at the worst possible moment, when your stock is already at the bottom. In volatile markets, we are talking about crypto, biotech stocks, commodity, futures. That 40 and 50% drop can happen in hours, not days, hours. And in extreme cases, like the crude oil crash on April 2020, when oil prices literally went negative, leverage traders didn't just lose everything. They owed money more than they deposited. Their brokers sent them bills. Let me show you two real examples. Same tool, completely different outcomes. Case 1. The disciplined trader. She has a $50,000 account and uses 2-to-1 leverage, the lowest tier. She never risks more than 1% of her account on any single trade, which means her maximum loss per position is $500. She sets a stop loss before she enters every trade, a price lever where she automatically exits no matter what. Over 3 years, she compounds her account at 22% annually. Not because she was lucky, because the leverage amplified her well. Researched, controlled risk positions, not her emotions. Case 2. The overconfident trader. He has $10,000. He used 10-to-1 leverage, controlling $100K in position. He seems a hot stock tip on Reddit. He goes all in. No stop loss. He tells himself he'll check it tomorrow. The stock drops 12% overnight on bad earnings. His $100K position is now worth $88,000. He owes $90,000 to his broker, $2,000 more than his position is worth. His account is wiped out, and he owes money. Same tool, completely different outcomes. The difference isn't luck. It's a position sizing, stop losses, and the ego to know when not to use leverage at all. Let's also talk about professional grade disasters. In 1998, Long-Term Capital Management, a hedge fund run by two Nobel Prize winners in economics, used leverage ratios for up to 25-to-1. They had $4.7 billion in equity, controlling over $125 billion in positions. When the Russian government defaulted on its debt, their models failed. They lost $4.6 billion in under 4 months. The Federal Reserve had to organize a bailout. If Nobel Prize winner can get destroyed by leverage, what do you think happens to the average retail trader? Okay, so leverage can destroy you, but clearly some people use it successfully. What are the rules? Rule 1. Never risk more than 1% or 1% to 2% of your account on any single trade. If you have $10,000, that means no single trade can risk more than $100 to $200. If you have $10,000, this sounds painfully conservative. It is intentionally. It means a string of bad trades won't wipe you out. You stay in the game. Rule 2. Never use maximum available leverage. Your broker might offer 10-to-1 or even 15-to-1 in the forex market. Using maximum leverage is not a flex. It is a confession that you don't understand risk. Professionals rarely use more than 2-to-1 to 3-to-1, even when more is available. Rule 3. Set a stop loss before you enter, not after. A stop loss is your exit price if the trade goes against you. You define it before you're emotionally invested, because once you're in the trade, your brain will rationalize holding on. The stop loss removes the decision from your emotional brain. Rule 4. Keep a cash buffer. Never be fully invested. Professionals keep 30 to 50% of their margin account in cash. Why? Because if a margin call arrives, they can cover it without being forced liquidated at the worst moments. Rule 5. Treat leverage like a scalpel, not a sledgehammer. Use it for precise, high-conviction trades where you've done the research, not for gambling on a stock tip. you saw on Twitter. The best trades I've studied use leverage sparingly, maybe 20 to 30% of the time. The rest of the time, they're in cash or using zero leverage. Here's the 3 things I want you to leave with today. First, margin is borrowed money. Leverage is the multiplier it creates. They amplify everything, gains and losses equally. Second, the margin call is the most dangerous moment in leverage trading. It forces you out at the worst time. You protect yourself by keeping a cash buffer and always using stop losses. Third, the difference between a leverage trade who builds wealth and one who goes bankrupt isn't intelligence. It's discipline. The rules are simple. Following them is what's hard. If this video saved you from a margin call or at least made one less likely, hit the like button. It takes seconds and it means the world to this channel. And subscribe if you want to understand every corner of how financial markets actually work, not the version they teach in school. Next week, we're going even deeper into the danger zone, short selling. Its leverage's more volatile, more misunderstood cousin. And it's how some of the most legendary trades in history were made. See you then.